Welcome to the Riskwiser Zone, the show where we dive into the world of stocks and finance to help you make informed decisions about your investments. We're starting off with a look at the latest news from the Indian market, where foreign investors have resumed selling after a brief pause in October. According to reports, they've pulled out a net Rs 3765 crore from Indian equities in November, driven by global risk-off sentiment and volatility in global tech stocks. This development comes as a bit of a surprise, given that the Indian market has been performing relatively well, with both the Nifty and Sensex hitting new records recently. However, it's clear that foreign investors are becoming increasingly cautious, and this is reflected in their selling activity. But what's behind this trend? Is it just a case of global risk aversion, or are there other factors at play? We spoke to some experts who pointed out that the outflows in November were primarily driven by volatility in tech stocks, as well as pockets of stretched valuations and subdued industrial indicators in the Indian economy. Despite this, not all indicators point toward a sustained bearish trend. Some analysts believe that there's still no clear evidence of a trend reversal in FPI flows, and that these investors may shift their strategy as conditions evolve. We'll be keeping a close eye on this story and exploring its implications for investors in the Indian market. In the meantime, it's worth noting that so far in 2025, FPIs have withdrawn over Rs 1.43 lakh crore from Indian equities. This is a significant amount, and it's likely to have an impact on the market in the coming months. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're diving into the world of artificial intelligence and digital infrastructure today. Our middle segment is all about two companies making waves in this space: Applied Digital Corporation and CoreWeave, formerly known as CoreWeave, but more commonly referred to in relation to another company. Let's focus on Applied Digital, APLD, and CoreWeave's competitor. CoreWeave isn't the main topic. Instead, we have CoreWeave's indirect competitor, Applied Digital, APLD, and a warning about another AI stock, CoreWeave. Applied Digital Corporation has announced plans to advance its AI factory projects in North Dakota, with funding from a deal with Macquarie Asset Management that could provide up to $5 billion. The company expects to draw around $787.5 million by the end of November 2025, which will be used to build two AI factory campuses, Polaris Forge 1 and Polaris Forge 2. This investment is a significant step forward for Applied Digital's AI infrastructure strategy and demonstrates confidence in the company's ability to deliver at scale. On the other hand, we have CoreWeave, an AI computing company, but today we are looking at a warning about another company often compared to CoreWeave in the AI space. A recent analysis highlights three key reasons why investors might want to exercise caution when considering CoreWeave's competitor. CoreWeave isn't directly mentioned, but for context, let's just say it is one of many in this space: operational challenges, valuation concerns, and the speculative nature of generative AI demand. While Applied Digital Corporation seems to be making strides in its AI endeavors, it's essential for investors to approach any investment decision with a critical eye, considering both the potential benefits and risks. As we navigate the complex landscape of artificial intelligence and digital infrastructure, it's crucial to stay informed and adapt to changing market conditions. Welcome back to the Riskwiser Zone. As we wrap up today's show, let's dive into a pressing topic that's been making headlines: the UK's economic landscape. Chancellor Rachel Reeves has unveiled a budget that includes a £26 billion tax hike to fund various welfare initiatives, sparking intense debate about the role of taxation and state support. On one hand, proponents argue that this move will provide essential assistance to those in need, helping to alleviate poverty and promote social mobility. The lifting of the two-child cap on benefit payments, for instance, is expected to benefit thousands of families across the country. On the other hand, critics like conservative leader Kenny Badenoch contend that such measures can be seen as unchristian, emphasizing the importance of personal responsibility and community support over state-funded welfare. Badenoch has also hinted at the need for restraint in spending, citing concerns about leaving debt for future generations. It's essential to acknowledge that this is a complex issue with valid arguments on both sides. As investors and individuals, it's crucial to consider the potential implications of such policies on the economy and our own financial decisions. As we navigate these uncertain times, it's more important than ever to stay informed and adapt to changing circumstances. Whether you agree with the Chancellor's approach or not, one thing is clear: the UK's economic trajectory will be shaped by the choices made today. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.